Friends, remember 2022, one of the worst years in crypto history? The massive FTX exchange collapse crashed Bitcoin below $16,000. XRP dropped to 30 cents, Ethereum to $900, and Solana below $9. This correction wasn't just about FTX, multiple factors drove it. US inflation soared to a 40-year high of 9% post-pandemic, and the Federal Reserve raised interest rates to 5.5%. Market panic spread with many investors selling off, convinced crypto was dead. But markets are living organisms, they rise and fall. That correction became the perfect time to accumulate assets at the bottom. Today, Bitcoin has recovered by over 400%. Not even considering its peak above $100,000. Why mention this? Because the market is again shaking out weak hands, preparing for the next growth phase. This gives those who missed last year another opportunity, but perhaps you're thinking, I've been averaging in all year, yet my portfolio is still red, and I have no money left. We hear this often. Step back and ask, are you investing correctly? Check your portfolio composition and accumulation strategy. Buying meme coins at peaks, panic buying dips, then calling crypto a scam during corrections. That's what 80–90% of newcomers do. If your portfolio drops 50% on a small pullback, you're ignoring basic investment principles. Today, I'll break down the latest news, reasons for the drop, and two critical things. First, how low the market could go, as indicators signal Bitcoin might test $70,000, especially with Trump's statements and rising inflation. Second, a guide on navigating corrections. How to buy dips and average in correctly to protect your portfolio while following core investment principles. If your portfolio is red and you're lost, watch until the end. Comment how long you've been in crypto and how many corrections you've experienced. The big question, why is the market dropping? Several negative catalysts exist, but the main reason is Trump's announcement about imposing tariffs on Canada, Mexico, and even Europe. Trump's statement triggered a domino effect. After Bitcoin fell below $90,000, crypto liquidations surpassed $1.7 billion, similar to February 3 when Trump first threatened tariffs. Tariffs are additional taxes on imported goods, making them more expensive for U.S. buyers. Companies usually pass these costs to consumers, increasing inflation. Trump argues this will strengthen U.S. manufacturing by reducing reliance on foreign goods. But trade wars hurt both targeted countries and the U.S. Other nations retaliate with their own tariffs, like China. While Trump aims to protect the U.S. economy, he's fueling inflation and straining relationships with key trade partners. Markets have already reacted negatively to rising inflation fears. Last Friday, consumer inflation expectations came in twice as high as forecasted, pushing markets down. Stocks also declined after a report showed weak consumer confidence data. These tariffs create uncertainty about U.S. economic stability in 2025. Since their full impact hasn't materialized, it's hard to predict how inflation will behave and whether the Federal Reserve will raise rates again. Investors typically price in worst-case scenarios, explaining the sharp drops. During economic uncertainty, investments in risk assets decline. In the past 2 weeks alone, over $2 billion has been pulled from ETFs, the largest outflow since Trump took office. Meanwhile, gold keeps hitting new all-time highs. Will the market keep dropping? Let's analyze. Bitcoin broke out of a consolidation pattern, breaking both its local upward trendline and the critical $90,000 support level. As predicted, losing this support triggered a test of the 200-day moving average around $85,000. Analysts like Alpha Bitcoin warned that dropping below $90,000 could lead to declines toward $80,000 or even $70,000. Another analyst, Michael Van de Poppe, pointed out that Bitcoin needs to absorb all liquidity between $83,000 and $87,000 before reversing. Bitcoin always collects liquidity after each pullback, which halts the drop and triggers a short-term bounce. Looking at the RSI indicator, we see it testing the oversold zone, which historically leads to price reversals. The 200-day moving average has been a key support level throughout the past year, with only 3 previous breakdowns. Basic technical indicators suggest we should expect consolidation above the 200-day MA and a short-term bounce. The Fear and Greed Index has dropped to 25, extreme fear territory. This means investors are scared, with many panic selling at a loss. Warren Buffett's wisdom applies. Fear and greed, these epidemics will never end in the investment world. Their timing, duration, and consequences are unpredictable, and we don't even try to predict them. Our goal is simpler: to be fearful when others are greedy and greedy when others are fearful. It's nearly impossible to pinpoint the exact bottom, but while funds and whales don't know where the bottom is, they stick to accumulation strategies and focus on key support levels. If you plan to hold long-term, DCA is best. Allocate a set amount, say $1,000. Set a buying schedule, daily, weekly, or monthly, and buy consistently, for example, $100 of Bitcoin per week for 10 weeks. This builds an average price while keeping cash available for dips. Michael Saylor follows this approach with an average Bitcoin buy price of $66,000. On Monday, he announced a record $2 billion Bitcoin purchase at $97,000 per coin, understanding this dip is temporary. Richard Ten, Binance's current CEO, not to be confused with CZ, stated that the recent 8% drop in crypto market cap is merely a tactical retreat, not a trend reversal. He pointed out that crypto reacts to macroeconomic factors but demonstrates resilience over time, referencing the 2022 correction where Bitcoin fell below $20,000 due to Federal Reserve rate hikes, but later recovered. Ten noted that the current downturn aligns with previous short-term corrections and doesn't indicate fundamental weakness in the crypto sector. Institutional interest continues growing with strong ETF inflows despite periodic outflows and regular filing of new applications. Ten explained the recent decline as primarily driven by economic factors, particularly the Federal Reserve's cautious stance on interest rates. The recent dip was largely due to the Fed's careful approach to rate cuts, making a March rate reduction less likely. Cryptocurrency has evolved into an asset class integrated into global finance. Ten emphasized maintaining a long-term perspective rather than reacting to short-term fluctuations, advising investors to remain calm. Excellent advice, as panic leads to impulsive decisions and greater losses. When building a portfolio, focus on the top 20-50 coins with solid fundamentals. Consider strategies like 70-20-10, 70% in Bitcoin, because it's the foundation, 20% in Ethereum, and 10% in fundamentally strong altcoins. You could use 60-20-20, but remember that increasing altcoin exposure increases drawdown risks. According to CryptoQuant, Whale Wallets purchased 26,430 Bitcoin in a single day on the 25th. A Bitwise analyst shared a chart showing Bitcoin's post-halving price dynamics, indicating the bull market's main gains are yet to come. Another analyst highlighted increasing Bitcoin balances held by public companies. We're no longer in 2022's rough environment. Today, we have Bitcoin ETFs, a crypto-supportive US government, and major SEC shifts. Several legal cases against crypto companies have been closed recently. That's why this local correction doesn't signal a market-wide crash. Keep following our videos and Telegram channel for the latest insights and news. Well, friends, that's all for today. Don't forget to subscribe to our channel to stay updated on new videos, and share your opinion in the comments. Good luck, and until next time.